Welcome to the Deep Dive, where we take a stack of information and get straight to the most important insights, giving you that shortcut to being truly well-informed. Today, we're looking at Realty Income Corporation, the monthly dividend company. And we're not just, dissecting their latest quarterly report, we're asking something deeper. How does this, titan of consistency manage to grow so aggressively, navigate global shifts, and still deliver on that income promise?
Yeah, that's the key question, right? We're going beyond just the headlines of their Q2 2025 report. It was filed just last week. We want to understand the strategic implications.
Okay.
How are they really performing? How are they managing this absolutely massive... Yeah, there are. What's really fascinating, I think, is their net lease approach. Think of it this way. When they lease a property out, the client, the tenant, they typically pick up the tab for property taxes, insurance, and maintenance.
Ah, okay, like a triple net lease.
Exactly, often triple net. It's kind of like owning a rental house where the tenant handles all the upkeep and the bills.
Right.
So this structure, it really shifts those operating costs away from realty income, makes their income streams, much more predictable. And the scale. It's just huge. As of June 30th, 2025, they own or have interests in, get this, 15,606 properties.
15,000, wow.
Yeah, leased to 1,630 different clients. And these clients are spread across 91 different industries. That's a serious footprint we're talking about.
That is a huge footprint. Okay, but you mentioned nearly 98% are single client properties, even with 91 industries. Does that create some risk? I mean, what if a big tenant runs into trouble?
That's a really sharp point. That's something analysts definitely watch. So, yes, the vast majority, about 97.9%, are single client properties. But their deep industry diversification is how they try to manage that risk. No single industry accounts for more than, 11% of their total rent. So even if one sector struggles, it doesn't sink the ship.
Gotcha. And property types, what are we mainly seeing?
Retail is the big one. Dominates at nearly 80% of their annualized base rent. Now, that might sound high, but it includes a lot of essential stuff: drugstores, supermarkets, convenience stores, things people need regardless of the economy, mostly.
Okay, less exposed to, say, apparel retail woes.
Out of over 15,000 were vacant.
Wow, okay. That signals pretty strong demand.
Very strong demand and efficient management of the portfolio. They're good at keeping spaces filled.
Okay, so massive, diverse, highly occupied portfolio. Let's connect that to the financials. How did this translate into top-line performance? How did the quarter look?
Well, for the 3 months ending June 30th, 2025, total revenue, it climbed, reached $1.41 billion. That's up from $1.34 billion in Q2 of 2024.
Okay, solid growth year over year.
Decent growth, yeah. And it kind of hints at how they're navigating things, maybe passing on some costs, maybe finding good acquisitions in a tough market. And if you look at the first 6 months of 2025, revenue hit $2.79 billion. That compares to $2.60 billion in the first half of last year.
Right. But what about profit, net income?
That's where it gets a little more nuanced. Net income actually dipped a bit in Q2 2025 specifically. It was $126.9 million, down from $259.4 million in Q2 2024.
Okay. Why the dip?
Could be various things. Maybe higher interest costs hitting that quarter, maybe some one-off property-related expenses. But interestingly, if you look at the full 6-month period, net income actually increased. It was $446.7 million compared to $391.7 million in the first half of 2024.
Okay, so the 6-month view smooths it out, suggests the underlying trend is still positive.
Exactly. The half-year view often gives a better picture, less noise than a single quarter. Shows underlying strength.
Okay, solid revenue, nuanced net income. But the thing everyone knows them for, the dividends. The monthly dividend company. How did they do there? Still living up to the name.
Oh, absolutely. They kept that train rolling. They actually increased the dividend 4 times just during 2025 alone.
4 times already?
Yep. As of July 2025, they've hit 111 consecutive quarterly dividend increases. And since they listed on the NYSE back in '94, they've raised the dividend 131 times.
That's incredible
It
consistency.
really is. It's a huge part of their identity and why investors like them. It really speaks to the stability of that net lease model we talked about.
Right. Okay, so we've got the foundation. How does a company this big actually grow? Where's the expansion coming from? Acquisitions, I assume.
Definitely acquisitions. They're constantly buying. In just the first 6 months of 2025, they invested a pretty substantial $2.5 billion.
$2.5 billion.
Yeah.
In 6 months?
Yep. That went into 176 properties, some properties still under development, and they even did some loans. Now, what's really notable here strategically is where they're investing. $1.47 billion of that $2.5 billion. That was invested in Europe.
Ah, okay. A big international push.
A very big international push. It really signals a strategic shift, maybe looking for higher yields, maybe diversifying away from just the U.S. market. It shows they're not just growing, they're evolving where they grow.
Yeah.
That's a big long-term play.
Makes sense. And what kind of returns are they getting on these new properties?
The initial weighted average cash yield, basically the initial return, was 7.1%. Pretty healthy.
Yeah, that's pretty good in this environment.
It is. And these came with long leases, too, a weighted average lease term of 10.5 years. That locks in income for a long time. And importantly, about 24% of the income from these new properties came from what they call investment-grade clients.
Okay, investment grade. So companies with strong credit ratings.
Yeah.
Lower risk tenants.
Exactly. It ties back to that risk management. Even when expanding aggressively, especially overseas, they're still prioritizing tenant quality. It takes more work, more due diligence internationally, but it's core to their strategy for reliable cash flow.
Right. Quality over just pure volume. Okay, so they're buying a lot. Are they selling anything or just accumulating?
No, they're definitely selling too.
Yeah.
Active portfolio management. In that same first half of 2025, they sold 128 properties,
Okay.
generated net proceeds of about $209.4 million, and they actually booked a gain on those sales of $61.1 million.
So profitable sales, not just ditching bad assets.
Seems like it. It suggests they're recycling capital,
Yeah.
selling maybe mature properties where the growth is done, and reinvesting that money into these newer, potentially higher-yielding acquisitions like the ones in Europe. It's about optimizing the whole portfolio.
They're smart. Okay, acquiring, divesting. Where's the cash coming from to fund all this? That $2.5 billion in acquisitions isn't small change.
No, it's not. They tapped the capital markets quite effectively. In those first 6 months, they raised $1.247 billion in net proceeds just from selling new shares of common stock.
Ah, equity raises.
Primarily, yeah. A lot of it came through their ATM program that's at the market. It lets them sell shares kind of continuously directly into the market when the price is right, rather than doing one big disruptive offering.
More flexible.
Much more flexible. And they also have another $422.8 million lined up from shares they've agreed to sell but haven't settled yet. It's the unsettled ATM forward equity. They expect that cash to come in by the end of September 2025. So another chunk of funding is already teed up.
Okay, so equity is a big part. What about debt? Running a company this size with this much activity, how do they manage their borrowing and make sure they have cash ready?
Good question. Looking at the bigger picture, their total capitalization, basically the mix of debt and equity, is huge, $82.2 billion.
Wow.
And liquidity is key. They reported $5.1 billion in total liquidity as of June 30th. That includes actual cash, that unsettled ATM equity we just mentioned, and crucially, a lot of available money on their revolving credit facilities.
Right, their credit lines.
Exactly. Having that much liquidity is vital. It means they can jump on acquisition opportunities quickly or, weather any unexpected bumps in the road.
Tell us more about those credit facilities. Are they new? What are the terms like?
They actually just refreshed them. In April 2025, they set up new ones. $4.0 billion in unsecured multi-currency revolving credit lines. These replace an older, slightly larger facility.
Okay.
These new ones mature out in 2027 and 2029. They have options to extend them, and they can even potentially increase the total amount to $5 billion if needed.
And the cost of borrowing with their reputation.
That's where their strong credit ratings really pay off. They have investment-grade ratings, A3 from Moody's, A from S&P. So their borrowing cost on these lines is pretty favorable. It's just 0.850% over the benchmark rates like SOFR, SONIA, Euribor.
So very cheap borrowing costs compared to many companies.
Very cheap. It's a significant competitive advantage. They also set up a separate $1.38 billion credit facility specifically for one of their investment funds, the U.S. Core Plus Fund.
Okay, so they have access to short-term cash. What about longer-term debt? Bonds and notes.
That's also grown. Their total notes and bonds payable stood at nearly $24.9 billion at the end of June 2025. That's up from $22.7 billion at the end of 2024.
Okay, another couple of billion added there.
Yeah, they've been active issuing new debt, too. In June alone, they issued a $600 million note due in 2035 with a 5.125% coupon. And they also tapped the European market with two separate $650 million notes due in 2031 and 2035.
Issuing in euros makes sense with the European expansion.
Exactly. Locks in euro debt for euro assets helps manage currency risk. Overall, the weighted average interest rate on all their notes and bonds is 3.9%, and the average time until maturity is 6.4 years. So pretty well managed, relatively low rate, and the maturities are spread out.
That's a lot of debt, though. Nearly $25 billion. How do we know they're handling it responsibly? Are there, guardrails, financial health checks?
Absolutely. That's where financial governance come and the rules set by their lenders.
And the good news is they're comfortably meeting all of them.
Like what? Give us an example.
Okay, one key one is the debt service coverage ratio, or fixed charge coverage ratio. It measures their... Another one, total unencumbered assets. Assets not pledged as collateral. Theirs is at 238.7% of their unsecured debt, way above the 150% usually required. So lots of assets are free and clear.
Right.
And one more thing on managing risk, they use derivatives, things like interest rate swaps and foreign currency forwards. Now, this isn't for speculation, not trying to gamble.
Just for hedging.
Exactly. It's smart financial planning. They use them to lock in interest rates or exchange rates for future obligations, protecting themselves from market swings. Super important given how much they're doing internationally now.
Okay, that makes sense. Now, when people analyze REITs like Realty Income, they often use metrics beyond just standard net income. You mentioned FFO, AFO earlier. Can you break those down? Why do they matter more for REITs?
Sure. So standard net income, GAAP net income, it includes things like depreciation, which for real estate companies is a huge non-cash charge. It makes reported profits look lower than the actual cash the properties are generating.
Right, because buildings technically depreciate on paper, but often appreciate in value in reality.
Precisely. So non-GAAP measures try to adjust for that. Management actually highlights adjusted EBITDA, that stands for real estate, as earnings before interest, taxes, depreciation, and amortization, adjusted for real estate specifics. They see it as a key measure of just the raw operating performance of the properties and their ability to cover interest payments.
I remember that.
For Q2 2025, the quarterly adjusted EBITDA was $1.28 billion. If you annualize that, it comes out to $5.14 billion. Gives you a sense of the underlying
Earnings power of the portfolio.
Okay. And FFO and AFO, how do they connect back to the dividends?
Right. FFO, funds from operations, starts with net income and adds back depreciation.
The cash actually available for shareholders.
Exactly. And for the first 6 months of 2025, their AFFO available to common stockholders was $1.90 billion. That translates to $2.11 per common or share. So that's the number that really gives you confidence in their ability to sustain and grow that monthly dividend. It's the cash flow backing the promise.
Got it. That's a much clearer picture of the cash generation. Okay, so we've seen the strengths, the growth, the financial management, but every deep dive has to look at the risks too. What potential headwinds does Realty Income themselves point out?
They're pretty transparent about the risks, which is good.
Yeah.
One key factor, especially with their growth ambitions, is competition. Lots of people want to buy the same kinds of high-quality net-leased properties. That competition could drive up prices, making it harder to find deals that meet their return targets.
Makes sense. More money chasing fewer deals.
Right. And linked to that international expansion we discussed, that brings additional risks. You're dealing with different legal systems, potential currency swings eating into your dollar returns, different economic cycles in different countries.
Yeah, managing operations across the U.S. and Europe must be way more complex.
Significantly more complex. It raises real questions about how effectively they can manage those diverse risks simultaneously. It's not just buying property, it's managing a global operation.
What about risks closer to home, like the properties themselves or the economy?
Yeah, they mentioned the risk of uninsured losses. Think major natural disasters or other events where damages might exceed their insurance coverage or where the deductible is really high. That could be a big hit.
And fundamentally, their success hinges on the financial health of their tenants. We talked about diversification, but if several major clients, even in different
Absolutely. They also flag inflation as a risk. If operating expenses, even the ones they do pay, rise faster than they can increase rents contractually, that squeezes margins. Plus, high inflation could strain their tenants' ability to afford the rent in the first place.
And what about those newer ventures? The gaming properties, data centers, do they bring unique risks?
They do. Moving into new asset classes or using different structures like joint ventures or making loans, it introduces complexity and potentially different risk profiles they might have
less experience with.
Right.
And a really critical one here. All these new activities have to be managed carefully to ensure they don't jeopardize their REIT qualification. The tax rules for REITs are strict.
Could cause major operational disruptions or reputational damage.
Okay. Lots to keep an eye on there. Well, this has been a really insightful deep dive. We've seen Realty Income actively growing, expanding internationally, managing a complex but seemingly well-structured debt load, and of course, delivering on that dividend.
Indeed. The financials show a lot of strength and smart strategic moves. But those risks, they outline global conditions, currency, tenant health, maintaining that REIT status while innovating. They really underscore that for a company this size, constant vigilance and adaptability are absolutely essential.
Absolutely. Which leaves us with a final thought for you to ponder. As global markets keep changing and new kinds of investment opportunities pop up, how does a company known as the monthly dividend companies strike that balance? How do they maintain that reliable payout history while staying agile enough to grab new opportunities and navigate the unexpected challenges of a really complex world? Thanks for joining us for this deep dive. We hope you feel more informed and ready to explore even further.